Today we're looking at an analysis called The Next Short Squeeze: Why Wall Street is Wrong About Opendoor. It argues Opendoor is set for a squeeze because the market sees an AI pivot that analysts with their backward-looking data are just completely missing. So let's jump right in. The report makes a really compelling case for this Opendoor 2.0 pivot, the one led by the CEO Kaz Nagiatian. And the promise is pretty radical. It's about replacing human inspectors and agents with AI and automation.
Right, taking it from a capital-heavy, low-margin house flipper.
Exactly, like 2 or 3% margins.
And turning it into this Shopify model with software-like profits, which is, that's the dream.
It's the dream, but it's also a massive operational leap.
It is, and that's where I think the analysis could be a bit sharper. The analogy positioning Opendoor 2.0 as the Shopify model shifting from low-margin real estate to software-like margins needs clearer specific metrics to fully bridge the massive gap between a capital-intensive flipper and a pure software platform.
That's a great point. It's asking us to believe the AI can just de-risk real estate.
Yeah.
Which is, a famously high-variance localized asset. And that somehow that removes enough friction to suddenly get SaaS margins. It feels big.
It is big. And while the report really nails the goal of the AI pivot, it leans a lot on that future potential without really quantifying the speed or the scale of the margin shift. The leap from a 2 or 3% margin to software-like feels a little speculative.
Especially when you look at the price.
Exactly. The stock's at, $770?
Yeah, and the bear targets are down at $1.40.
So that's a 400% plus divergence right there. The market has already priced in a ton of success. So it's not enough to just say the pivot is coming. The market is waiting for proof it's actually happening now.
Okay, so if the market's already paying for the promise, the report has to show how that progress is measured. But how do you even do that for something that's, still scaling?
Well, you don't need perfect audited numbers. What you need are actionable, forecasted KPIs. To make this forward-looking story really robust, the report should bring in some forecasted margin improvements, or maybe specific KPIs tied to software scalability. Anything to make the projected profit feel less abstract.
Okay, so give me an example.
Sure. For instance, you could quantify the impact of automation on a per-transaction basis. Like, how many basis points of margin are saved on every single home sale because the new AI tool eliminated an inspection error?
Right.
You could put a hard dollar saving on that.
Right.
Or you could project a timeline, even a rough one. When does the capital-heavy flipper revenue start giving way to higher-margin platform revenue?
And even if that new part is only, say, 10% of the business at first.
Exactly.
Quantifying it gives that $7 valuation some real concrete support. It anchors the whole thesis.
Precisely. You've got to show the mechanics of the pivot, not just the ambition behind it.
That idea of numerical justification flows perfectly into the next point, which is the core conflict of the whole piece. This huge divergence between the market price at $770 and the analyst targets down at $1.40.
Yeah, and the report lays out the bear case pretty clearly. Revenue declines, fear about interest rates, margin compression, all the stuff based on the old Opendoor 1.0 model.
It's all backward-looking.
It is, but this is where the analysis needs to do more than just diagnose the problem. To maximize the urgency of the bear trap thesis and justify the existing great divergence, the report must more aggressively and specifically connect the proposed catalysts to a valuation metric that explicitly invalidates the extreme $1.40 price targets.
I completely agree. The analysis is great at showing why the bear models are obsolete. Because they ignore the AI pivot. But it doesn't quite connect the dots. It doesn't link those bullish drivers, the AI, the potential rate cuts in December, to a new number that justifies $770.
Right.
So that 400% gap feels rhetorically powerful, but numerically, it's a little insufficient.
It leaves you thinking, okay, the bears are wrong. I get it. But what's the actual math for why the bulls are right? You have to give the listener the ammunition to just crush those lowball targets.
So what's the suggestion?
I think it needs a dedicated subsection, one that explicitly models a valuation bridge from the bear assumptions at $1.40 to a new justified forward-looking price target based on Opendoor 2.0 actually working. That's how you reinforce the idea that analysts will be forced to capitulate.
Okay, I hear that. But let me push back a little.
Sure.
Isn't just slapping a full tech multiple on the company the exact kind of speculative move analysts are trying to avoid? We don't want to create a bull case that's just as abstract as the bear case. Just, at the other end of the spectrum.
That's a very fair challenge. And you're right. The solution isn't to just apply a tech multiple to the entire revenue stream tomorrow. That's not credible. Instead, you model how applying a moderate tech multiple to only a fraction of the business,
The new high margin part.
the new high-margin part post-AI pivot. Show how that alone, that small piece, pushes the blended valuation past the current 770 level. That gives you a numerical floor for today's price.
I like that. Or you could use the macro angle.
Or you go with the macro angle, which might be even more conservative. Model the increase in transaction volume from the anticipated rate cuts in December 2025.
Because that would unlock all the frozen housing inventory.
Exactly. That volume surge alone would shatter the revenue assumptions in the bear case. And you can show how that invalidates the 140 target even without assuming a big margin improvement. It's a second independent path to a higher valuation.
That's crucial. That shift from here's why they're wrong to here's what the right number should be just adds so much credibility.
It turns it from a debate into a modeling exercise.
All right, let's talk about timing, because for a short squeeze thesis, that's everything. The report discusses the trigger, and it identifies some really strong catalysts. You've got the high short interest, 16.3%,
Which is a lot of fuel.
a lot of fuel. You have the meme factor, and then you have the golden signal, the CEO's $1 million insider buy in November.
A huge confidence signal.
Yeah. And then separately, in a different section, the technical analysis notes a bull flag pattern with a breakout point above 850.
Okay, and that's the issue right there. It's a great setup. You've got fundamental conviction, short vulnerability, technical compression. It's perfect. But for a squeeze, the trigger has to be immediate and obvious. The structural setup for the squeeze would be sharpened by integrating the technical analysis signals directly into the trigger section, positioning the bull flag breakout as the definitive, imminent mechanical event for forced capitulation.
I see exactly what you're saying. By putting the technicals in their own section later on, it delays the most actionable point.
It buries the lead.
Right. Because the combination of the insider buy, which is the fundamental backing, and that specific price level that breaks the bear trend, that's the whole story for a squeeze.
It is. The short interest is the fuel. The CEO buy is the match. But that technical breakout, that's the fuse. And you need to light that fuse for the reader right away in the narrative.
So how would you restructure it? You'd merge the sections?
You merge them, combine technical analysis with the trigger, and you use that bull flag and the 850 breakout point as the specific, immediate mechanism that forces the shorts to cover.
So you're basically treating 850 not just as a pattern on a chart, but as a critical line in the sand, a trapdoor for the shorts.
It's the point of no return. You restructure the whole section to present that 850 breakout level right after you talk about the 16.3% short interest and the insider buy. You frame it as the thing that happens next.
So you'd say something like,
You'd say a sustained close above 850 would be the technical signal that leverages the high short interest and the insider confidence into a rapid move toward $10.50 or $12. It connects the qualitative why, the pivot, the CEO's belief, directly to the quantitative when, the 850 price level. It tells the reader exactly what to watch for, right now.
that makes the entire analysis so much more urgent and actionable. Okay, this is an extremely compelling report. The narrative around the AI pivot and the squeeze potential is strong. Let's just quickly summarize the ways to make it even stronger. First, solidify that fundamental story. You have to strengthen the Shopify model analogy by actually quantifying the margin shift. Move from potential to projected KPIs.
Yes, show the numbers, even if they're just projections. You need to show how you're measuring the success of Opendoor 2.0.
Second, you've got to directly invalidate those 140 bear targets with your own forward-looking numbers.
Build that valuation bridge.
Exactly. Use a partial tech multiple or model the macro tailwind. Don't just say the bears are wrong. Show what the right number is and how you got there.
Close that rhetorical gap with a real financial model. Justify the current price and the target.
And finally, for that immediate impact, integrate the technical breakout point, that 850 level, directly into the squeeze triggers. You have to position that as the definitive line in the sand that forces the shorts to capitulate.
Yeah, that's the key.